It's time now for Channel 9 business and finance editor Ross Greenwood to bring down the hammer on property investment.
When buying a property to live in or to rent as an investment, the yield is always a really good guide as to the price you should pay. Now, yield is pretty simple. It's the rent you could receive divided by the price you pay. Clearly, the higher the yield, potentially, the better deal you're getting. But yield is affected by a few variables. First is the rent you receive, or potentially could receive. If it goes up, the yield goes up. Conversely, if you have to cut the rent to get a tenant, that yield goes down. Then there's price. The more you pay for a property, the lower the yield. The less you pay, the higher the yield. In other words, the best properties have rising rents and low prices. As capital city prices have fallen in the past 2 years, yields have been going up, giving a clue that there's value out there. Right now, for example, the average yield on Sydney apartments is said to be 4%. In Melbourne, 4.4%. In Brisbane and Adelaide, 5.4%. But right now, remember one other important factor. Bank interest rates when you borrow can be as low as 3.25%, even below 3%. That suggests if you can maintain the rental levels and get a low rate loan, the tenant will pay off your interest plus more. Forget negative gearing, this is positive gearing, and it's one reason smart buyers are picking the eyes out of property markets and getting in right now. Remember the keys to this? Make certain the property can be let. Make certain your lending is secure. For these conditions are the seeds of future property investment success.